All right, guys. So today we are going to continue with our YouTube mentorship. Today is day 26/30. So we thank God for how far we have come. Next week Tuesday should be US elections. Right. So be very careful. This is election period, right? Be very careful with your trades, right? Because of this today is the 29th of October. So I think the election is on the 5th. So the market should be very volatile then. So it's best you stay out of the market, that period, actually fourth, fifth, that time, right? So it's best you stay out there. Right. So let us talk about a very simple topic. We might not take too much time today. We'll talk about daily bias, right? So this is actually a very interesting topic, right? Daily bias, right? So daily bias is one of ICT's most interesting topics, right? So one of the topics that many people, in fact, I don't think it's only ICT. No matter what you trade, right? Whether you trade, head and shoulder, you trade double tops, double bottoms, you trade trend line breakouts, you trade anything at all, as long as it involves a chart, right? The most important thing, in fact, even if you don't use a chart, maybe use other flow or those volume indicators, right? The most important thing that you want to know, right, is very simple. This is the question that comes into your mind whenever you enter your chart. What is that question? What is that question that comes to your mind? That question is very simple, right? That question is simple. Let me just type it out. Is price going up or down? That is it. So this is the most important question that every trader asks whenever you come to the chart. You're asking this question. Okay, this is what I'm looking at on the market, right? Does price have a tendency to go up or does it have a tendency to go down? Let me just give you a few seconds to think about that. Are you done? All right. So this is the most important question that every trader asks, right? Is it going up or is it going down? Right? Are we going bullish or are we going bearish? Are we going to buy or are we going to sell? This is the question. It's either price is going up or it's going down. Because look at your chart. Either price is going up, even if it's in the range, it's still go up and down, right? Is it going up or is it going down? That is the most important question that every trader asks whenever it comes to the chart. And that this lecture is an attempt to answer the question, right? It's an attempt, meaning that I will try my best to see how to give you perspective to the underlying question. However, you still have to put in the work to understand better and to there are certain markets that have certain characteristics, right? So you have to put in the work to understand what I'm teaching you. So what I'm teaching you is clearly from the chart perspective, what you should look at. Now, for you to be able to effectively tell daily buyers, the first thing that you must understand is number one, you ask yourself these two questions. Where is the liquidity? This is the first question you ask. Where is the liquidity? Where is the fair value gap? These are the two things that I know that drop price. These are the two things that attempts to answer the question. Of course, another thing that also affects is fundamentals, right? Fundamentals are the determine where price, it's kind of helpful to know where price is likely go to, right? But from a chart perspective, right, this we should be covering today. From a technical perspective, we ask two questions. Where is the fair value gap and where is the liquidity? These are the two questions that if you can answer them properly, then you will be able to tell where the market is going, right? That is essential to trading daily buyers, right? So the market is either drawn to a liquidity point or it is drawn to an area of what? Imbalance, where price has not been balanced. And another name for fair value gap is what? Imbalances, right? All right. So whenever I say fair value gap, I'm referring to imbalances. All right. When I say liquidity, I'm referring to old highs and old lows. Right. That's what I mean by liquidity. Old highs and old lows. The old high might be equal highs. It might be a single high, maybe triple high. Right. Then it could also be a trend line. So liquidity also depends on trend line. There's a trend line, or maybe a kind of channel or something that a pattern that might allow people to be in a trade. Retail traders, when they use their lines, they feel that retail traders always feel that their line controls the market, right? They feel the line controls the market because look at this now. Someone saw this line and the person will be like, okay, look at this line, right? What happened? You can say the line breached, you can say the price breached this trend line here, just pushed a bit above, and then it acted as if, look at this, this is something, look at this. And if you do it this way, you see how price as if it closed above, it had as if it retested. You can say market kind of acted like it retested it, and then you can see how it continue going down. Right. So that is what you should ask. Where is the liquidity? Where is price? Which high or low is price likely to attack? Right. Which high or low is price likely to attack? That is what gives you the essential to the fair to the listen to the daily buyers. So you want to know for today what price would likely do for today, and the question you answer is liquidity. Now, under this liquidity question, number one, there are two things to look at, right? Under the liquidity aspect, right? On the liquidity aspect of this question, there are two things to look at, right? This is my perspective. You look at what the So you look at the immediate run liquidity. Which one has been run? Like which liquidity has just been run, right? It gives you a perspective. Now, let me explain this. Now, if you are trying to, let's say you're trying to, you're trying to buy a market and then price pushes above this high, right? Now, price pushes above this high, right? Now, if you look at this market very carefully, that means that this high is the immediate run liquidity. That means this was the most recent liquidity that was run, right? Now, even if this market is bullish, seeing that price has run this liquidity, right? Your daily buyers would not be buy anymore because after price runs liquidity, there's always a tendency for a pullback to occur. Are you getting it? So liquidity helps to tell you where the market is likely to go because now you have known that whenever price runs a high or low, there is a tendency, right? Not 100%. There is a very high probability or tendency that price is going to retrace before continuing what going bullish or reversing. So it could continue going bullish or it will just completely reverse. However, you should not be expecting market to continue going bullish after a high. Imagine that you're trying to buy up here. It doesn't make any sense. You see that the market has taken out the previous high and you're trying to buy up there. It doesn't make any sense, right? It's always better whenever the market takes out a recent high or recent low or an immediate liquidity, you do what? You look for what? A proper retracement, right? So this is number one. Now, have you understood how daily bias, these things help you to frame your trade idea? Now, if you are someone that does reverse trading or counter trend trades, once price goes above this, you can look out for what sell confirmations, maybe on the lower time frame, they catch yourselves to maybe let's say 50% of the range, right? Or let's say you target the next fair value gap. Maybe if there's a gap, fair value gap inside there, because okay, this is my target, fair value gap here, or whatever you want to do to to be your draw. Right. Okay, I've said talk about liquidity already. Let's focus on liquidity. So let's just leave fair value gap for now. Right. Now, that is how you should, view it. Now, for another point in the liquidity aspect is what? Look at what? The opposing liquidity targets. Right. That's another thing you must ask yourself. Where is the opposing liquidity target? Right? The opposing liquidity target. Right. So now the next thing that you do is that you ask yourself, where is the opposing liquidity target? It's very important because this gives you a perspective to what price likely will likely do, right? Because if you know the opposing liquidity target, then you can know that okay, price is likely to go to that point. Don't worry, I'll give you guys from real chart perspective. Let's just before we go to the fair value gap aspect, let's just do some some talk with these things I've just mentioned before we go over to the fair value gap aspect. Let's just talk about this right briefly. All right, so look at this now. This is 15 minutes or this is a 5 minutes chart. Look at this. We just 5 minutes chart just for this example, right? Now, this market is bearish, right? Is it bearish? Yes. Now, look at how price went below this low. Taking out what? This means that the immediate run liquidity is what? Sell side liquidity, right? Is the downside. The downside means sell side. The upside means buy side, right? So the lower end of this has been taken out, meaning that whoever was buying inside there has been taken out by this what week, right? Does it make any sense to be selling down here anymore? Why? It doesn't make sense. Why? Because the immediate run liquidity is on the sell side. That means you expect what? Some kind of retracement. So let's assume that maybe you went to maybe you did okay break out the test. You went and you break out the test. Maybe you went and sold it. You have taken a very huge loss on this because why? The draw has is now pushing what to the upside, right? Can you see it now? Um, Now after that, what happened? Price pushed up, tapped into let's say price tapped into this last order block here, right? Price tapped into that other block there, and then as price tapped it, what happened next? What would we do in this case? Our target becomes what the opposing liquidity, which is what this, right? Whenever I see long weeks, I like to use this the one that goes to the body because most of these weeks are manipulation. So I like to focus on this the body of candles, right? I mean if you want to use you have still been correct, rather. But I don't really like using I don't really like using long week as my target, right? So for me, I would preferably use this one here because this one is kind of more, you know, more direct, right? So however the case is when you are coming from an order block, what now becomes your draw? What your draw becomes what this old low. Not only that, look at this. We also have what this trend line. Look at this trend line that was forming down here. Look at this, right? So you can say we have two draws of liquidity to the downside, right? Can you see it? First touch, second touch, third touch, right? Or even if you didn't see the third one, this is the, look at these two touches here. So I've drawn out in time, and look what happened. Markets, breached it and then what? Dropped to the downside, right? Now look at one funny thing that happened there. The market did this, and the can market what said dropping down to what the what opposite liquidity. So you should always be mindful of the direction that price has just immediately run, and then look for what an opposing target. Right? Look at this one. Now this market run was liquidity. Look at this. Immediate run was what the downside liquidity. We were in a bullish market, and then this was what an order block, right? This other block here, right? This was an order block. We ran liquidity to the downside, see this liquidity run to the downside, tap into this other block, start rejecting from the other block. What do you expect? The next liquidity is here. Look at this equal highs here. Look at this. Can you see this equal highs here? Look at this highs here. This relative equal highs, this trend line. You can see how these highs were lining up there, right? This is liquidity to the opposite end. We took out this immediate liquidity here. We took out this buy side liquidity here. So let's say sell side. Look at this. We took out sell side twice, took out the sell side, and then pushed above. Took out sell side and then pushed above. Now, what do we see here? We also see what? This opposing liquidity here, right? Can you see how these things were lining up for what? A buy, right? We're in a bullish trend. Remember, you must always consider the trend of the markets, right? Don't just take trend without understanding the trend. That is it. I'm not showing you guys the lower time frame aspect. When we go, but of course, you have to look at the daily charts to understand this I'm talking about. And I will talk about daily charts once we head over towards the fair value gap aspect. Now, we have understood the first question, where is the liquidity? Now, the second question is, where is the fair value gap? Because liquidity and fair value gaps act as what? Price magnets, right? Liquidity and fair value gap act as what? Price magnets. And this word is our keyword for today because whoever, I'll pick a winner from this. Whoever is able to tell me this, what I said there, liquidity and fair value gap act as what? Price magnets. So if you can tell me that liquidity and fair value gap act as price magnets, you're the winner, right? So just tell me, type it in on your Twitter and then tag me. Liquidity and fair value gap act as what? Price magnets. So I'll pick in a winner to a cash prize today. I picked two winners, so two people can go around. So 5,000 each person. Just tell me this. Liquidity and fair value act as what? Price magnets, right? That's it. So now, the second question you ask yourself is, where is the fair value gap? This gives you an idea of what to expect because the same thing liquidity does is the same thing the fair value gap also do. They drop price to themselves. Now, fair value gap act in two ways. Number one, act as a magnet. That means it's fair value gap here, price like to draw towards it, right? It acts as a magnet and what? So fair value gap act as two things. Number one, it acts as what? A magnet and what? A um a wall. Yes. So it's fed out as a magnet and then what? A wall. That means when price is far from a gap, it tends to drop price towards itself. And when price gets there, it tends to act like a wall. That means price can usually bounce off it, right? Price can bounce off it or breach. But most times you will see that once price hit a fair value gap, there's usually a reaction. Like when you throw a ball and a ball hits a wall, even if the ball will break the wall, but there will be a kind of resistance. You understand? If you're running towards the wall now, and even if the wall is very soft and it breaks, there's going to be a kind of pullback, a reaction when you come in contact with that wall. That is how fair value gap acts. It acts as a wall. Once price hit it, it acts as a wall. Also, let us talk about magnets. If you put a nail near a magnet, let's say this is a magnet now. Let us say this is a magnet. My God, this class is getting very interesting. All right. I wish I would say something like a magnet here. Since there's a magnet, something like a magnet. Let me just quickly see if I'll see magnet here. I used to see magnet down up here. I used to see it. I don't know if it's still there. This is something like a magnet. Okay, it's not there. Let's use this as the magnet, right? That's why this is a magnet. This is a magnet, right? And um um let's use this as the nail, right? So this is a nail. So now this nail is coming close to the magnet. You can see the magnet is drawing the nail is this is a pendulum. So the pendulum, let's say this is this magnet, let's say this magnet is a let's say a fish, right? Let's say it is a fish. And this magnet is a fish, and the pendulum is coming to the fish. What's happening? Immediately the magnet hits the fish, there will be a kind of reaction because a fish is solid and the pendulum is also solid, right? The fish is not going to enter inside the pendulum at once, and the pendulum is not going to enter inside the fish at once. There's going to be what? A reaction, like a reaction. So even if the pendulum end up eating the fish, like it covers up the fish and eats it, it's not going to just be without a reaction, right? Or even if the pendulum decides to ignore the fish and pass, like it ignores the fish and pass, there's going to still be some kind of reaction first before it passes and then moves along. So that's what I mean. So whenever price hits a fair value gap, there is bound to be a kind of reaction, like it push a kind of resistance. So we use fair value gap as targets. Whenever I'm bearish on that, I use the gap as my profit target, right? Or if I'm bullish, I cannot expect price to react on what? My gap. Right? So we have talked about, let's go to the daily chart and that's give more perspective to what we have been saying. I don't switch to this thing will work. Okay, thank God. So let's go to this one. So daily charts. We're talking about daily bias now. All right, let us give some live examples now. All right, now look at this example. Very, very easy. Very, very clean. Very easy. Look at this. Like I told you, look at how the market breached this high, right? Now, what do you expect? Do you expect that price above this? No, although it came in for some while, this price is not probable. What happened next? We saw the market was drawing lower. Now, what happened? That below this low, this was a draw liquidity number one. We had this draw liquidity here. This draw was the first target, which was the old low. That means if you are up here, your draw your daily buyers would have been bearish. Maybe after seeing maybe 1 hour break or structure or something, your buyers would have been what? Bearish to the downside. They're just been bearish, 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 bearish. And then look at this gap here. Look at this family gap here. Look at this gap. Did you notice that immediately price hit this family gap? Can you see this reaction? Look at this. Just pay attention to this. Like, look at this level here. Look at this L level. This low means the low. Open, high, low, close. Right? Look at this low here. The low of this candle is at 1.29745. Why the low of this candle is at what? 1.29739. So this is 45 and this is 39. That means price actually deep into what this gap. Can you notice that immediately price deep into this gap? Like Look at this. Can you see this immediate reaction? Like, can you see these two bullish days? That's what I was telling you about. So gaps act as what? Like a wall. Once price is drawn to it and bounces off it or touches it, that's usually what? A reaction. Right? So whenever you're taking a trade and price hits a gap, expect some reaction. Although it might break it later on. Look at this. Look at another day. Market still came there again. Casa price pushed up again. Like it's although it breached, but look at how this kind of closed doji. It still pushed up one more before there was going below. I was to remain fight was draw. So this was a draw. Casa price was just dropping to this liquidity, and Casa market pushed above, right? So that's how you frame delay bias. So even if you are if you, let's say you are inside this place, this is another block, right? We are looking for sales. Why? To take out this low and want to push towards this gap. Not only that gap, we still have what? A bigger gap below. Look at this bigger gap down here. Look at this one. What's have another family gap here? Can you see how price is reacting? Look at how price bounced off. You can see market pushed up the next day. Right? That is how it acts. So whenever you're in the market, expect price to draw to liquidity areas or fair value gaps, and then expect what? Reactions. Right? Now look at something that happened there. Look at this. Just pay attention. I'm taking you somewhere. Look at this. Look at this gap inside there, right? Look at this gap here. Can you see how the market drew towards it? And what happened next? You can see the sell down today. You just look at 1, 2, 3, 3 day sell because what? Market bounced off a wall and then what? Pushed to lower. And now this wall, this family gap was preceded by what? An order block, right? I told you guys about synchronous order blocks. So this order block, that one I'll teach you guys about high probability order blocks tomorrow. High probability order blocks. High probability order blocks. That will be tomorrow's topic. High probability order blocks. I'll tell you guys when order block is high probability and when it's low probability. Right. So can you see it? So my whole point is that whenever you see a gap or a liquidity point, expect price to draw towards those areas because that is where look at another liquidity we have here. Look at this. We have this liquidity area here. Look at this. We have this hold low here. So that's also a liquidity point. Who knows? Price might want to push to this point here. It's very possible. Right. Let's look at another chart. Let's look at maybe the Nasdaq on the daily chart. Right. Look at this. Can you notice that although let's just start from down here, market broke bullish somewhere around here. We had a bullish break, right? What happened? The market came. You can see how the market was coming to retrace. Imagine that after this bullish break, we are trying to buy up here, right? Maybe you saw this. You can say you have gotten a good loss, right? And then you can see price pushed. This is a bullish market, right? How is it bullish? You can see what's higher low. Then you can see how price ran this liquidity. Why? Why did price run this liquidity? Why did they run it? Because what? There was a gap below it. So whenever you see a magnet below an old low, old high, that tells that price is going to likely run it. So this is another way to see it. Whenever you see a fair gap below a low or above a high, that means that it's likely for price to run out liquidity and was tap into that magnet down there. So this is the magnet, and this is also a magnet. So this magnet is lower than this magnet will always drop price to itself, right? You can see price pushed, and then you can see price closed above the gap, right? It did not close below. So whenever a market is failing to note something, price can always go below a gap, but look, pay attention to how it reacts. If price goes and then it started reversing almost immediately, that means the gap is likely to hold. So you can say it pushed, although but you still can say it reversed almost immediately, right? So now look at another one here. That price fill this gap here. So, and then what happened? Immediately started reversing. Although it closed, we can say after it closed, next thing it started reversing immediately, right? And then price has been was pushing for highs. So this high, as market took at this high, sorry, can see what the retracement, and then that has been history, right? So now what do I expect on this guy? It's very obvious. I expect price to push to this high, right? Now look at what price is doing currently. Let us do a real example now. So the example is that look at this example here. Now we have a fair value gap acting as a wall here. So inside, no, okay, there's no gap yet. So look at this. So we have this liquidity target resting here, and then price has already pushed above this. So let us see what price is going to do. Right, there's a likelihood that price might retrace, I don't know. So I can't really tell for now, but this is our drawn liquidity. If you ask me, is that old high there? I told you guys that old highs and old lows are as liquidity spots, as well as fair value gap, right? So maybe tomorrow, I don't want this call to be very long. Maybe tomorrow we'll talk more about this, right? So Tomorrow we'll continue with daily bias, and then we'll go over to high probability other blocks, right? So don't miss tomorrow. Let us not make this class so long. So do how to identify, this is your assignment, identify draws of liquidity on your chart. Where what was obvious to you when you open your chart? Where did you mark out and say, okay, price is going to go here? Was it a fair value gap? Was it a liquidity port? Was there a reversal? Was it a reversal? I told you guys that when price takes an immediate liquidity support, there tends to be a reversal. So see you guys in tomorrow's class. Subscribe, like this video, and see you tomorrow.